In this lecture, I cover mutual funds investing. So, why mutual funds? Now, there are five benefits as you can see on the screen. The first is the benefit of diversification without a large investment. So, what is diversification? Diversification is not putting all your eggs in one basket, meaning you allocate your funds over several investments instead of putting it all in one. And the reason this is required is it reduces the risk. And this is proven statistically. We'll get into the details probably a little later. Not in this lecture at least. Next is save on brokerage on purchase of similar portfolio. So if you were to mirror a mutual fund and allocate your funds in the same number of securities that a mutual fund is going to invest in, you would stand to lose on brokerage. And the reason mutual funds can get this done is because they obtain discounts because of large volumes in transactions in terms of brokerage. So that's why you get the benefit of economies of scale. Now, next is experienced fund managers take care of the portfolio. So you don't really need to worry about what stocks to invest in, how to invest, when to invest. You have outsourced that headache to fund managers, and they basically take care of the portfolio which is held by the common public. Next is less monitoring required compared to equities. Now, since you have professional fund managers who are experienced in managing investments, there is lesser monitoring required. And then you have high liquidity, and these can also be bought on exchanges. Not all mutual funds, but yes, some of them can be bought on exchanges, and we'll get into the details in the next slide. Well, these are some of the reasons why you can invest in mutual funds. Now, as you can imagine, there are costs involved. A mutual fund is run by professional managers, hence they need to manage their paychecks. Their operational expenses are covered through the gains and through and these are all recovered from you as an investor. So if you would invest in equity yourself, you would probably make more returns, although the initial costs, as we've seen, would be higher. And also the hassles of constant monitoring of your own portfolio versus mutual funds. Now, what are mutual funds? So we understood why they are important. Now let's actually understand what they are. So mutual funds are investment companies, and these have professionally managed portfolio of securities. They offer their own stock to the public. In return, the public gets diversification benefit. Now, mutual funds can either be open-ended or closed-ended. So there are two kinds of mutual funds. First, let's look at closed-ended funds. Now, closed-ended funds are like publicly traded companies. They obtain funds for an IPO-like transaction, which is known as an NFO or a new fund offering. Next, the mutual fund units, like stock, are subsequently traded on exchanges for closed-ended funds, that is. Now, the price of each unit is market-driven and fluctuates like stock price. So that's closed-ended funds for you. They are like publicly traded companies. They offer an IPO-like transaction called an NFO, through which they obtain the initial funds from the public, and then the funds, then the mutual fund stock gets listed on the stock exchange and gets traded like any other stock. Now, in the case of open-ended funds, they offer securities directly to public and are not exchange traded. So what this allows them to do is they have no restriction on the total number of shares that they can issue to the public. They can raise more capital by issuing even more mutual fund units. The only flip side is they cannot list on exchanges. Now, since they can't be listed on exchanges, the prices of open-ended funds are not market driven. So they are priced at the asset value, that is the net asset value. So that's point number 7, where units in open-ended funds are bought on net asset value held by the company in securities. So that's the assets which they hold. They're basically investment companies, and they all they have are securities. So you divide the total number of securities that they hold by the number of shares that they are issuing. This gives us something known as NAV per share. So the NAV per share is essentially the price of open-ended mutual funds. So point number 8 is just reiterating the fact that the price per unit is not directly determined on demand and supply. So that covers mutual funds in a nutshell. Thanks for watching, and if you're on YouTube, don't forget to subscribe for more awesome videos. Stay tuned, and I will catch you in the next lecture. Bye for now.